Hello Proponomics people, good morning and welcome to the Sunday supplement summary from the supplement from the 14th of April 2024, which I called an alternative perspective on the rental market. And what I did in this week's supplement was effectively summarise the macro landscape as we see it at the moment, relevant for property investors, and also then went into a deep dive on a report from the Resolution Foundation, which is about the ever-rising cost of rent. So I'm just going to go into those in a bit less detail than the full video, which is around about half an hour long, that I posted last night. So first of all, the Resolution Foundation is starting from the premise that the housing market is not delivering for low to middle income families. Now, they take out of context the fact that rents have moved up 18% since the beginning of 2022, rather than putting it into context, which they do in fairness deep in the body of the report, but not in their headline summary. Since then, benefits are up over 21%. LHA is up around 17%, although remember it had been frozen for some time since April 2020. And also wages are up 13% since then. So not terrible. They also share later in the report that the rents were 5% below the longer term trend line, which they have data back to 2000, showing a nice dropping percentage of income being spent on rent by families. Now, this is where myself and the foundation started to part company quite significantly, because they just seem to have either are deliberately living in denial or don't have the experience within the property rental market to really frame the problem correctly, or they just don't have the data, because the data on rentals is just not very good. And I'm not suggesting it's any kind of conspiracy at all. I think if you didn't work in the sector or weren't knee deep in the sector day to day, you wouldn't necessarily understand the rental market with the detail that some of us do who deal with rental properties day in and day out. So what's the big thing essentially that the foundation are missing there is that there's been a complete change in circumstances, and then another step change again in circumstances since George Osborne's budget of 2015, because all the individual landlords were wanted to be replaced by good old George by private companies. The problem with private companies is what they generally want is brand new, shiny assets, no real risk whatsoever, and they just want guaranteed returns. So no problem, move them towards the build to rent sector. The build to rent sector, which by now, 9 years later, from George's budget, we're a couple of months off the 9-year anniversary of that budget, has delivered 90,000 new units to the UK. 90,000 in 9 years, so 10,000 units a year. Now, there are various different estimates for how many rental units are needed every year at the moment, but some credible estimates suggest about 200,000 new rental units per year are needed. Now, of course, the reality is, the problem is, where are those locations? And then when you look at the mix of build to rent in general, we're not talking single family homes near schools. There are some BTRs that are like that, but not many. The vast majority of schemes are effectively just on the outside of the suburbs or the outskirts of a city centre in one of the big cities in the UK. Who are they trying to capture? They're trying to capture the graduates who are working Big Four accountancy jobs, consultancy firms, great graduate programs where they're on 30 plus K a year to start with, more if they're down south, and therefore they can afford £1,300 a month rent or similar amount of money. And that's the people that they're trying to skim off the top, graduates, and then those living the single life into their late 20s, early 30s, whatever society deems fit these days, realistically, or however long someone wants to stay in that lifestyle before they pair up, if they get married, have a family. Of course, that's happening less and less because birth rates are dropping. But that's what Build to Rent has really sought to service, which hasn't solved any of the problems in especially secondary towns where there are many more renters, because apart from anything else, wages are not sufficiently high enough as a rule for people to feel that they can take on the asset that is also can be a liability of a house. You know, the average person who's an owner-occupier in the UK with a mortgage earns about 60k. That's the household income. And the average renter household earns about 30k. Those are the two medians that I'm comparing. And this is a bit of an inconvenient truth that's left out of the figures, but that's the reality of the disparity of the income gap between the two different types of tenure in the UK. So obviously a massive gap there. So the foundation haven't really encapsulated this in their figures, I don't think, as a general rule, or in their analysis as a whole. They also, largely speaking, have ignored that overall inflation landscape that I've talked about, There are definitely some points of merit within the report. Some bits that I did agree with. I did like their overall analysis in terms of rents going to be rising. They think 13% over the next 3 years. I actually think that looks low. That's 4.2% a year compounded. But then I'm looking at it from a province's kind of perspective, not from a nationwide perspective. It may well be that London is very, very close to its affordability ceiling, if not there already in certain parts. And of course, the London pricing does impact the overall pricing in the marketplace. So we do have to bear that in mind. They also point to 38% of landlords having no mortgage. Now, that might be 38% of landlords, not 38% of rental properties. The UK finance data suggests that 55% of properties that are in the rental sector don't have encumbrances against them. I find that figure mind-blowing, as I've said before, but UK Finance have probably got the best data. Well, they've got the best data out of everybody. But you can just see from this conversation that ultimately the data in the sector is still problematic, and we don't see. I mean, they're suggesting 47,000 rental units have been lost since 2019 overall. Again, they don't discuss the fact that all of those extra rental units we've needed every year, and the massive increase in rental units that we will have needed with net migration of around 1.3 million over the past 2 years. And of course, we don't know yet what the net migration figures are going to settle down to, if that's a kind of post-pandemic blip, or I think more people are being driven away from because of climate change in various parts of the world, and we're not really taking things like that into account. But of course, there have been tightenings in the immigration system to try and prevent what's been deemed to be a problem by the current administration of people solely trying to get access so they can bring dependents over, not so they can come over and work. And the realistic message is we want to import people to work. We don't want to import people to use our schools in the NHS. And that is reality, and probably economic reality as well, so you can understand it. I think they've also missed the point. They've suggested that mortgages can't be the reason why rents have gone up, the increase in mortgage costs. But I don't know another business whereby all costs would go up, and I'm talking insurance, compliance, maintenance, everything else, including the interest rate costs, which have gone up massively, and that doesn't push up the cost of delivery, especially in what economists call an inelastic good, aka the price goes up 1%, the demand goes down by less than 1%, because it's an essential good apart from anything else. They're concerned that wages aren't going to keep pace with that 13% over the next 3 years. I would agree. We've had figures this morning that say wages are still going up 6%. They are going to be sticky. So I'm expecting 5% over the next 12 months as an average, which should roughly keep pace with rents, although rents in the provinces I think will go a little bit higher. I also think the Scottish figures need to be thrown out of the mixer because the Scottish rental figures are not accurate. On the macro side, then, parking the Resolution Foundation for the moment, I went into the GDP growth, so a surprise revision from 0.1 to 0.2 to 0.3 for January's figures, and then February's figures were out and it was another 0.1% growth. So that leaves the 3-month GDP at plus 0.2, so healthy enough. And next month we should be seeing a disappointing November drop out of the figures, and we'll be seeing the March figure come into it, which should be quite good because Easter was in March, although that extra bank holiday never helps GDP. But I think March will be around about flat, and then we'll be at about 0.4 for the first quarter. That's what I'm seeing. Where are we also at with oil prices? Could be a little bit inflationary at the moment, obviously with the context of what's going on in the Middle East and the escalation and the potential further escalation of conflict there. I also talked about the retail figures, significant rise year on year. All of that growth is in food, non-food items. Retail is actually falling, and this is pre-inflation. So retail are going to be struggling massively with the cost and the impact of the minimum wage rises because they use the minimum wage more extensively than anybody else. I also got into the RICS house price balance and went into that report in some detail. So perhaps no surprises, still more tenant demand being reported, plus 19 on the index, less landlord availability, less landlord instructions, fewer of them, minus 19 on the index. The overall house price balance, minus 4. So very nearly as many surveyors thinking the market's going forward as it's going backwards. And I think that's a really, really good suggestion of where we are at the moment, especially with the bond yields wilting a bit. And that's what happened last week. Just to round off, bond yields moved up to back over 4% on the 5-year. So that's about as high as I think we're going to bear at the moment. but lots of reasons to be stronger for longer when growth figures are looking as healthy as they are. Thank you.